Good morning, everybody. Thanks for joining me this morning. My name is Ruth Benson. I'm the Employer Liaison Officer for NILGOSC. This morning's session, I am going to talk you through a little bit about what will happen in the event of a redundancy, what happens to your pension benefits. We'll look at your pension savings and the impact then that a redundancy will have on those pension savings. We'll break it down and we'll look at, in particular, the under age 55 group. So if you're going to be under 55 at the point in time of the redundancy or potential redundancy, that's the section for you to listen out to. We'll then move on to look at what will happen if you're 55 or over at the point of redundancy. At that point, I will then move over to our online demonstration. So I'll show you all how you can get your own redundancy figures, and then there'll be an opportunity for questions at the end. So getting started then. First and foremost, I'm going to talk about what is a pension with the local government pension scheme in Northern Ireland. So this is for the non-teaching staff. If you're a teacher or a lecturer, this session isn't for you. This is just for non-teaching staff that are members of the NILGOSC pension scheme. We offer a defined benefit, and what a defined benefit means is the pension that we pay you is determined by the regulations. So it's your length of membership in this scheme and your pay that determine the benefits that we will pay out. It's not a pot of money that can go up or down with inflation or with investment performance. Your benefits are defined and they're set out in law. We are currently a career average revalued earnings scheme. Sometimes that's called a career average scheme or a CARE scheme for short. That pension, once it comes into payment, is payable for life. So for however long you live in retirement, that pension will be paid to you. It is index linked, so it'll rise each year in line with inflation, meaning that it won't be devalued over time. So if you're made redundant aged 55 or over, that pension will go on in payment for as long as you do in retirement. It's not like there's a pot of money that's going to run out eventually. It will just remain in payment for as long as you live. If we look at a career average account, the key thing with a career average pension scheme is that every year counts. In this example, we have 5 years in the career average scheme. The opening balance in year 1 was 0. We have an annual pay for year 1 of £23,500, and your pay in year 1 will have been told to us by your employer. We'll take that pay, divide it by 49, and in this example, it means that there's £479 of new pension savings. It means then at the end of year 1, there's a closing balance for this example with a career average annual pension of £479. Year 2, the pay increased to £29,500. So you can see that the new pension savings also increased for that year, and they managed to bank £600 in that year. At the end of year 5, you'll see that the closing balance is an annual pension of £2,982.98. So this example has 5 years in the career average scheme, and they have an annual pension of just shy of £3,000. Once that pension comes into payment, it will remain in payment for as long as you live. If you have final salary benefits, they're calculated in a slightly different way, but they'll be paid at the same time as your career average pension. In this example, their annual pension was £2,982 and some pence, and that's what we refer to as the standard benefits. This is the position that's going to give you the highest amount of annual pension. But when you do come to retire, regardless of whether you're made redundant or whether you're claiming deferred benefits that come into payment, you will have an option to take some annual pension and convert it to tax-free cash. And it works on a ratio of 1 to 12. So for every £1 of annual pension you give up, it buys you £12 in your tax-free lump sum. In the example with the standard pension of 2,982, if we go for the maximum conversion, it will reduce that annual pension down from just under £3,000 to just under £2,000. It's coming down to £1,917 and some pence, and it increases the tax-free lump sum up to £12,784. I do have to point out that while the maximum tax-free cash option can look attractive, I do have to point out that the lump sum may not replace the value of pension given up. If, for example, you had a crystal ball and you knew you were going to live in retirement for longer than 12 years, you'll know if you'll have done yourself out of money by doing the maximum conversion. But it is an option that's there, and it's there for you to weigh up for your own circumstances. It may be that you've something sensible to do with that lump sum that will provide additional income for you, or maybe you're going to use the lump sum to clear any debts or outstanding mortgage that will mean that you have less outgoings in retirement. But it's entirely up to you, and it's a decision that you'll need to make when you're claiming your benefits. If we look at what happens to your pension then when you're faced with a potential redundancy situation, with redundancy, there has to be no longer a need for someone to do your job anymore. That vacant post is not going to be filled. Efficiency of the service is similar to redundancy in that you get the same level of benefits that are paid out. However, with efficiency of the service, there's no statutory requirement for a statutory redundancy payment. So how that impacts your pension and your retirement lump sum will depend on your age. And if we look first at those who are under age 55, you'll be qualifying for deferred benefits. As long as you've got more than 2 years membership in this scheme, you'll have deferred benefits. If you are made redundant and you're under 55 and you have less than 2 years, you will be entitled to a refund. So what we do is we calculate the pension that you have built up until that point in time that you're made redundant, and we will close the pension off. It'll be increased each year in line with pensions increase orders. So you'll be able to see from your annual benefit statement how much that's increased each summer. And it will then become payable at your state pension age. When you're a deferred member of the scheme, the death grant is no longer going to be 3 times your assumed pay. Once you're a deferred member, the death grant becomes 5 times your deferred amount of pension. Survivors' pensions are payable to any eligible survivors in the event of your death as a deferred member. While you are a deferred member after being made redundant under age 55, you do have some options. You'll have the choice that you can elect to claim early payment, and you can do that anytime from you reach age 55. However, there will be reductions that will apply to your benefit for them coming into payment early. What I would recommend is you get on to my NILGOSC pension online and run your calculation and see what the reductions would impact on your deferred benefits. You have some other options. You can choose to combine with a new future pension pot. For example, if you take up employment with another NILGOSC employer at some point in the future, you will have a new NILGOSC pension pot, and you'll have the option to combine or aggregate your 2 NILGOSC pensions. However, you only have a year from joining the new scheme to do that. We'll write out to you and give you your options. If you join another employer, maybe that doesn't participate in the NILGOSC pension scheme, maybe they have their own pension scheme, you can choose to transfer your NILGOSC pension to your new pension provider. We would always recommend you get a quotation to find out what your options are. And if you get a quotation, there's no cost. You can get one each year free, and there's no obligation to proceed. We would recommend always getting a quotation to find out what your benefits would be worth. Just be mindful that your new pension provider may have a time limit on when they will accept a transfer. Quite often pension schemes will only accept a transfer in your first year of joining. If you are thinking about transferring, there's a link in here on this part of the slide that I have put that will take you to our website, where there's a bit more information to do with freedom and choice in relation to transferring out your benefits. And of course, there's always going to be the ill health retirement option for you. It's payable at any age. If you suffer from ill health and you're permanently incapable of working, you can contact us and we can put you down the ill health retirement route. Most importantly, with an ill health retirement from deferred status, there is no enhancement that is added on once you've left the scheme, but crucially, there are no reductions applied on account of early payment. This next slide I've put in here that shows you what the reductions are. So if, for example, you're aged 45 and you decide to accept the redundancy, we will calculate your deferred benefits. You then have options so that you can voluntarily request payment from your 55th birthday. And if you do that at 55, you will see that depending on when your state pension age, there is a reduction that's applied to your pension. If your state pension age is 68 and you want it payable from 55, there's going to be a 45% reduction to your pension. Your final salary benefits will have less of a reduction because they're still linked to age 65 payable date. Bottom line is get online, run your calculation to find out what those percentages mean to your pension. Okay, if we look now at what happens if you're 55 or over at the point of redundancy. Crucially, pension benefits are payable, and most importantly, there will be no reductions. So if you're 55 at the point of redundancy, you won't have that 45% reduction applied to your benefits. Instead, there will be a cost to your employer, which will offset the strain on the fund for the early payment. That pension is payable for life. So if that comes into payment at age 55 and you live for another 40 years, it will keep paying you for that duration of time. Crucially, of course, it will be increased with pension increase orders, so it will rise each year in line with inflation. And there's no impact if you take up another employment elsewhere, or there's going to be no impact to your pension once it's in payment. There's no abatement. While you are a pensioner, the death grant is slightly different. So for a deferred member, the death grant becomes 5 times your deferred pension. But once you've retired and your pension comes into payment, the death grant, if you die within your first 10 years of retiring, it's calculated as 10 times your annual pension less what's already been paid. Essentially, what that means is that we're guaranteeing to pay this pension for at least 10 years. If you die within those 10 years, we can't pay you 10 years worth of pension. So instead, what we'll do is pay the balance to your loved ones. There are, of course, survivors' pensions payable to any eligible survivors that you leave behind. Now, I've mentioned a couple of times about getting online to your online pension account to get your own quotations. It also is crucially important that you keep your expression of wish up to date. And what that is telling NILGOSC who you want us to pay the death grant to in the event of your death. It's so very important, especially as if you're under 55 at the point of redundancy and you have deferred benefits with us. You may forget about us because you'll have a new job at some point with a new pension. And that may be your focus, but do please keep checking in online each year, check how your deferred benefits are doing, and do confirm your expression of wish, just so that we have up-to-date details as to who you want us to pay the death grant to. You can also let us know if you move house at any point. There's also a facility whereby you can contact NILGOSC, and at this point I'm just going to step across and share my screen. Bear with me. This should bring up our homepage. I'm sharing my screen now. So this is the NILGOSC website. While I'm here, I want to talk about deferred members. So if you leave the scheme and you're under 55 and you have deferred benefits, it's this section up at the top here that's for you. This will detail what your options are, what happens if you rejoin the scheme and things like that. You'll also see if there's any training and events coming up. So if we've got any sessions specifically for deferred members, you'll find them in there. This is also where you'll find a bit of information about transferring out. Down the left-hand side here, transferring deferred benefits. If you click on that, there is a little video that does explain what happens if you transfer your deferred benefits. It's only a couple of minutes long and it is worth a watch. But there's also information about being fraud aware and just being alert to any potential dangers of pensions liberation. I would recommend, if you are thinking of transferring out, do have a wee read through that information on our website. And then for those of you that are 55 or over, when the redundancy happens, your pension will come into payment, so you'll be classed as a pensioner. So it's the pensioner section up here that will be relevant to you. We'll have a list of all the payment dates throughout the year, so you'll be able to see for each month what day your payment's going to hit. And it also has some information about method of payment, and if you want to change your bank details, you can either do it on this form or on your online account. But this is the section for you if you're going to be a pensioner in the event of redundancy at 55 or over. But I'm going to look now at my NILGOSC pension online, and I'm going to sign into the demo account. Do please feel free to sign into your own account while I'm doing this, and you can follow through at the same time as me. Once you get online to your own online account, we're going to be looking at the calculators here, because we're going to be looking at what happens in the event of redundancy. So over here, we're going to go to the benefit calculators. So if you scroll to the pension benefits tile and then select benefit calculators, there's going to be two calculations. If you're going to be under 55 at the point of redundancy, we're going to be looking at the deferred benefit calculator. Now, with the deferred benefit calculator, it's the same calculation that we do for a retirement. The only difference is that your pension won't come into payment. So if I get the deferred benefit calculator open, this will default to today. So the selected retirement date is assuming we're leaving the scheme today. But if you know that you'll be leaving the scheme at the end of March, or maybe it's June, you just simply change those dates. So we can put in the 31st of March 2024. Scroll down to the bottom and click calculate. I haven't changed the pays because these are the pay figures that your employer told us at the end of March last year. The reason why I don't change those figures is because this is going to be an underquote. Most likely you'll have got an increment, or maybe there was a cost of living increase. So you might actually find that from April last year, your pay is going to be a little bit higher than the pay they put in at the 31st of March. But simply to err on the side of caution, I leave them as what they were, because at least then in that circumstance, it's going to be an underquote rather than an overquote. Just to confirm, the difference between these two pay figures is the care pay is your actual earnings. It will include any additional hours or overtime that you work throughout the year, but most importantly, it's your part-time earnings. So if you are part-time, it's your part-time earnings in the year. For final salary benefits, we use the full-time equivalent. So if you're part-time, we prorate up to the full-time equivalent pay, and we ignore any overtime or additional hours. So that's how sometimes you see a different pay. Crucially as well, for the final salary pay, it's not the rate that you end on, it's the rate that applies over a 12-month period. So for example, if you're going at the end of June, you get your pay rates that kick in potentially from April. You'll be on one rate from April to June, but you might have been on a different rate the previous March all the way back to July. So it's not the pay you end on, it's the pay over the last 12 months. It could be so many months at one rate and the remainder of the months at another rate. So that's why we recommend just defaulting to the pays that we have here, because at least then it's an underquote rather than an overquote. Once you're happy with the figures, with your retirement date and your pay figures, you can click calculate. And what that will do is that will talk directly to our system and it will update your details. And you'll see up here the annual pension then for a deferred member is coming out at £5,539. If you've done this in your own account, you will be able to see the deferred pension that you would be entitled to if you left the scheme at the date you put in here. Now that pension is the pension that will be payable at your state pension age. If you want to bring it into payment earlier than state pension age, that's when we're going to see the reductions. Once you are a deferred member, you'll get a new choice of calculator, and once you are deferred, you'll be able to run your quotations then to see what an age 55 retirement quote would look like. Crucially, there's no there's no option to do your conversion options for an annual pension into lump sum, but I will come back to that shortly. I'm going to now look back to the benefit calculator. So if you're 55 or over at the point in time of redundancy, this is the calculator for you. We're still in the pension benefits tile, and this time when we go into benefit calculators, we'll be looking at the redundancy or efficiency retirement calculator. So this is where you're going to go if you're going to be 55 or over at the point in time of redundancy. This is going to be similar to the deferred calculator in that it's going to default to today. As long as you're 55 or over today, it will default to your figures today. So we'll see there the selected retirement date is the 1st of February. So again, if you know that the redundancy is going to kick in at the end of March, change your date. Or if it's going to be June, change your date. Again, it's the same issue with the pay. This is going to be the pay as at the 31st of March last year. Chances are by now your pay is a little bit higher, and if you want to use the current year's pay, you can do so, but just be careful. If you're overinflating your pay, it will also overinflate your results. So I would always recommend to err on the side of caution and just leave the pay details that we have in there, because at least it's an underquote rather than an overquote. But again, if you're changing any of these figures, you just scroll down to the bottom and hit calculate. So once you've hit calculate, that will update your figures at the top, and that is going to show you the amount of pension that would be payable in the event of redundancy at the date that you have provided in the calculation. In this example, it's slightly under the 5,500 because I didn't change the date. That's still the 1st of February. But crucially, again, there's no automatic lump sum. You will only have an automatic lump sum if you have membership of the old 80th pension scheme. So if you were a member before the 1st of April 2009, you will have built up some years and days in the old 80th scheme, and it will default to your automatic lump sum in here. However, if you join the scheme on or after the 1st of April 2009, there's no automatic lump sum. Instead, we start with the highest pension that is payable. I will move on to quotation or calculation of the redundancy, and that is going to bring me to the conversion option slides. Hopefully you can all see this slide. When you're made redundant or when you are calculating deferred benefits, the online calculator will not show you what your conversion options are. However, there's a slide here where I'm going to teach you how to do it yourself. And if by the end of this slide you're able to do these conversion options, you're very welcome to apply for a job in our calculations team, and you can use me as a referee. But if we look at the conversion option calculation, the formula is 20 times your annual pension less 3 times your lump sum. You work out those two figures, so you get your annual pension figure from your online account, and in this example it was £2,982. You substitute that 2,982 for whatever your annual pension is, and you multiply 20 times your annual pension. What you then have to do is multiply your lump sum by 3. Now in this example there is no automatic lump sum. If you do have an automatic lump sum from your membership before April 2009, you multiply that lump sum from your online calculator, you multiply it by 3. So you've got your two figures then, you take your lump sum times 3 away from your annual pension times 20, then you divide all of that by 56. And what that does is it gives you the maximum amount of pension that you can convert. And in this example, it's coming out as £1,065.35. That's the amount of pension that you can give up and convert to lump sum. So the next step we have to take in the calculation is step number 2. This is where we take your annual pension from the calculator. So in this example, it was £2,982 and some pence, and we take off the answer from step 1. So we deduct 1,065.35, and that gives us the reduced annual pension that is payable in the event of a maximum conversion. So in this example, 2,982.98 less 1,065.35, that brings the reduced annual pension down to £1,917 and some pence. The next step of the calculation is where we have to work out the tax-free lump sum. So we take the amount that we were allowed to convert from step 1, that's the 1,065. We multiply it by 12 because it's 1 to 12 is the conversion ratio. So we multiply the amount that we can convert by 12, then we add on any lump sum if we had any, and that gives us the maximum amount of tax-free cash.
Ruth, we can't see the slides. The slides haven't moved. We're still on the My NILGOSC pension online, you know, the slide that says that. We can't see the calculations.
Okay, thank you. This happened last Friday as well. Leah, are you able to take over sharing of the screen?
Yes, Ruth, I'm here. Yeah. Sorry, I can't see your slides. I'm not sure what
Ruth, sorry, Rebecca from Belfast Met here. Ruth, because this happened last week, if people actually just click along the bottom, you can actually move forward the slides on the screen. So if you can't get it synced, you can do it by yourself. So Ruth, if you just reference what slide you're on, people should be able to move to it rather than having to take it down, if that's any easier. Thank you.
Thank you, Rebecca. We're slide number 13. If everybody wants to move just below where my slides are shown, there should be a wee arrow where you can move to slide 13 of 20. But Leah, please do feel free to share as well, because hopefully that would work. So if I go over this slide again, well, I'll give everybody an opportunity to get to that slide first. Apologies for this.
So yeah, that looks like it's working for most.
Okay. So slide number 13, the conversion options. You need to go online to your online calculator to get the amount of your annual pension and also take a note of any lump sum that you're entitled to. So that will either be in the redundancy calculator or in the deferred benefit calculator, whichever one is going to impact you depending on your age. When we come to work out the maximum conversions, we will take 20 times the annual pension. Now, this is step 1 of the formula on slide number 13. And in this example, I've used an annual pension of 2,982 and 98 pence, but you substitute that figure for whatever your annual pension is on the online calculator. You multiply your annual pension by 20, and that will give you a big number. The next step is take your lump sum. If you joined the scheme on or after April 2009, you won't have an automatic lump sum. So like this example, you'll be multiplying 3 by 0, which is 0. If you have a lump sum, you'll multiply that by 3. So you take 3 times your lump sum, you deduct it away from 20 times your annual pension, which gives you a big figure. What you then do is divide that figure by 56, and that gives you the maximum amount of pension that you can convert. So that's the amount of pension that you're going to give up if you go for the maximum tax-free cash option. Step 2 of the calculation is to work out what your reduced annual pension would be if you go for the max conversion. So in step 2, you take your annual pension as it was on the online calculator. So for this example, it was 2,982, and then you deduct the amount that you have worked out in step number 1. So for this example, that's the 1,065.35. You deduct that from your annual pension, and that will give you your reduced annual pension. In this example, that's £1,917 and some pence, and that's the reduced annual pension. Step 3 is where you have to work out the tax-free cash that you have used then through your maximum conversion. It works on a ratio of 1 to 12. So you take your answer from step 1, which for the example is 1065. You multiply that by 12, and then you add on any lump sum that you may have. And that gives you the maximum amount of tax-free cash that you can take. So the standard benefits in this example was an annual pension of 2982 and no lump sum. But if they want to do the maximum conversion, they can reduce their annual pension down to 1917. So that's just shy of £2,000 that will be paid every year in retirement. And they will instead receive a tax-free lump sum of 12,784. When you come to retire, whether you're bringing your deferred benefits into payment early or if you are being made redundant, we will issue you with claim forms, and those claim forms will confirm these conversion options. It's just unfortunate that the online calculator doesn't provide conversion options for you at this point in the process. When you are coming to claim your pension, you can choose either to go for the standard benefits, which is the maximum amount of pension, or you can go for the max conversion option, which is the maximum amount of tax-free cash with the reduced annual pension, or your other option is to go somewhere in between. It may be that you have a little bit of debt that you want to clear off, so you know you need, say you need £7,000, you can convert some of your annual pension up to that amount that you wish. You can use it to clear those debts, meaning then you've less outgoings to receive off the reduced pension. Hopefully that was clear, and I do apologise for anyone who's not a numbers person. If you're not a numbers person, don't panic. You can contact NILGOSC, and indeed whenever we're issuing you your claim forms, we'll do the hard work for you. But as I say, if you can follow that calculation, you'll be able to do that for yourself. I've put this slide in here, but I'm not so sure of its relevance. The government has done this research that they have published via retirementlivingstandards.org.uk, and this is a lot of research into people's expectations and lifestyles in retirement and how much money they feel that should be coming in each year in retirement. This isn't going to be assuming that you're 55 and being made redundant. This is assuming that you're reaching state pension age or thereabouts. So presumably your kids will be a wee bit more grown up. Maybe there'll be grandchildren instead. So your circumstances may be very different at the point in time of the redundancy than they would closer to state pension age. So that's something that you really need to factor in. They've recommended that at around about state pension age, the minimum amount of income that you want to be in receipt of, so how much your annual pension is going to pay out, they're saying that to cover all of your needs with some left over for fun, that as a single person, you should be aiming to have an annual pension of £12,800. When you're made redundant, you may not be close to state pension age, so you need to factor in the fact that your state pension won't come into payment early. It would only be your NILGOSC pension, so that's something to be mindful of. They're saying that for a couple looking for the minimum standards, that you should aim to have around about £19,900 coming in between the both of you. The moderate lifestyle is looking at more financial security and a wee bit more flexibility. I think they factor in the odd holiday every now and again, and they even factor in how frequently you'll be changing your car, and so they've increased those limits there. And then of course there's the comfortable amount. This is really where you're getting 3 weeks abroad every year and you're changing your car every 3 years. They're recommending a lot higher of an income, but the most important thing is that you have to remember that once your pension comes into payment, it may come into payment before your state pension age. So you may have a bit of a wait. If you have housing costs, you're going to have to factor that in, because these sort of rule of thumbs don't include any housing costs. So if you will have a mortgage to pay or any rent, you'll have to add that on to the amount of income that they're recommending that you have saved up for. So that's taken me to the end of what I wanted to talk about with pensions. The key things to take home is, if you're made redundant and you're 55 or over at that point in time, your pension is payable immediately without that 45% reduction to your pension. That pension is payable for life as soon as it comes into payment, and that means that it will be index linked and it'll rise each year in line with inflation. You may take up other employment somewhere else, or you may indeed take up further employment with a NILGOSC employer. That's fine. You can start contributing to a new pension scheme. That's no issue. Your pension that's in payment will remain in payment, and then if you start building up another pension pot, you'll have another opportunity to take your pension and your lump sum in retirement whenever you eventually leave that post. If you'd like to discuss any of your pension options, you can contact us. Hopefully you'll be able to follow through that calculation in slide 13, and hopefully that will get you a close enough figure. I do want to point out, if you have AVCs, that the calculation is slightly different, but if you use the same method, you should be close enough to a ballpark figure, including your AVCs, so as you'll know roughly your position. But as I say, NILGOSC will confirm that in your retirement claim forms. Slide number 16 here is in relation to where you can get more information. I pointed out on our website where the different sections are. There's a lot of information on there. Do have a wee read through, and of course use your NILGOSC pension online account. We have two guides specifically for these circumstances. The first one is called Leaving the Scheme Before Retirement, and that's if you're going to be under age 55 at the point in time of the redundancy. That's where you're going to be getting deferred benefits from us. So have a wee nosy through the grey guide called Leaving the Scheme Before Retirement. You can get that on our website or on your online account. However, if you're going to be 55 or over at the point in time of redundancy, it's the retirement guide that you want to look for. I've also put in a couple of links here. One of them was just the freedom and choice. If you're thinking of investigating a transfer out, follow that wee link and have a wee read through that information. I've also put a link to MoneyHelper. This is a place that can provide guidance, and it's provided by the government, so it is impartial, it is completely unbiased, and they'll be able to give you any guidance. I've put a wee link to one of the MoneyHelper slides here in slide number 17. It's somebody had asked me about what happens to my company pension if I'm made redundant. Because we're a defined benefits pension section, I've just taken a wee snippet of the MoneyHelper's website and put it into slide 17. And basically it's too small for me to read, but they are recommending that if you're made redundant, chances are, if you're thinking about transferring out, usually it's going to be best for you to leave it with the scheme. However, there are some circumstances where you may wish to transfer, but there's a wee disclaimer on that, so do have a wee read through that. And finally, of course, the last bit that I'm going to point out, the government has been working really hard to crack down on pensions liberation, pension scams in recent years. And one of the things that they ask all pension providers to do is highlight some warning signs for their members to watch out for. If you are contacted by somebody out of the blue, maybe it's a text message, maybe it's an email, maybe it's a phone call. If somebody has contacted you out of the blue in relation to your pension, that's actually illegal, and you should report that company to the Information Commissioner's office. If somebody is guaranteeing you high returns, so if they're saying transfer your benefits to me and I'll give you high returns on your investments, that should be an alarm bell. Nobody can guarantee any returns on investments. So if they're saying they can, that's an alarm bell that this could be a scam. Similarly, if they're offering upfront cash incentives, or if they're offering access to your pension before age 55, these are alarm bells because of the tax relief you get for pension savings. HMRC is only happy for you to benefit from that tax relief if it's savings for a bona fide retirement. And the UK minimum retirement age in any pension scheme in the UK is age 55. So if somebody is promising you access to money before age 55, that's an alarm bell. No reputable company would do that, nor will they offer you upfront cash incentives to transfer. And key, there's time limited offers. No reputable company will be putting time limited offers on you. So they're all alarm bells that you should watch out for. If it sounds too good to be true, it probably is. And at this point, I'm going to say apologies for the technical difficulties we've had this morning, but that's taken me to the end of my presentation. I see somebody has their hand up. Stephen, I will come to you in a wee moment. There was an email that had come in where Pat had asked about what happens, what's the process. Do you have to tell NILGOSC that you're retiring, or does your employer? So I just want to give you a brief overview of that, and then I will come back to the questions. But Pat, you'd asked, so in the event of redundancy, whether you're 55 or over, you and your employer agree that between yourselves. And then, depending on your age, your employer is going to let us know what happens. If you're under 55, your employer will tell us they're terminating employment on redundancy grounds. They've got 10 working days after your last payment from them to get that information through to us. They'll pay you whatever redundancy payment they're going to pay you, and then we'll write out to you within 3 months to let you know what your deferred benefits are and what your options are with regards to transfers. If you're accepting the redundancy and you're 55 or over, your employer has 5 working days instead of the 10 working days to tell us about it. So they make their last payment to you, whether that's the end of March, then they've got a week to tell us that you've gone and to confirm your pay details. We then have 2 weeks to calculate the pension over the last year and add that on to any other pension savings you have. And then we will oh, hang on, I've missed a step. They will tell us in advance of your date of leaving that you have gone down the route of redundancy. So they'll tell us, and we'll then issue you with claim forms. And really, as soon as possible is what we say. So as soon as you agree the redundancy, they will contact us and give us the date. We will then get claim forms out to you. That's where we're going to show you your maximum conversion options, and that's where you fill in your bank details. Then once they've paid their last payment to you, that's when they've got a week to confirm your final pay details. So that's another crucial thing. When we issue the quotation, we're still going to be using the same pay figures that you'll see online. So they're going to be last year's figures because we haven't got this year's figures yet. So at the claim form stage, it's still just a quotation, and it will compare to your online calculation. So once we get your claim forms back and once we get your final pay detail in from your employer, that's when we have 1 week to do our calculation. 2 weeks to do the calculation. We'll calculate how much pension that you've built up, add that on to any pension savings you had from previous schemes, and then we will pay your pension out. Pension comes out normally at the last banking day of each month. So for an example, if you leave at the end of March, if we have all the information in within the next couple of weeks, we will aim to have your pension paid before the end of April. But we have to have close for pension cut off. So if we've missed that closing date, it may mean that we won't get your first pension paid to you at the end of April. It may be that it'll be the first week in May when we pay your lump sum. But once we pay your lump sum, we'll also include the arrears from April's pension. The other thing that I want to point out, if you do have AVCs, that can add on another bit of a delay because we need to contact the Prudential after you've made your last payment to them, and we need to request disinvestment of those funds. We then have to wait for that payment to come through to us, so that can add on potentially another week, potentially 2 weeks, just depending on the timing of things. But if we are running late with getting your pension payment, we will include the arrears of any monthly pensions along with your lump sum payment. Okay, so let me open it up to the floor. Does anybody want to unmute themselves and ask me a question?
Yes, please.
Go on ahead.
Okay, so I expect to be issued a voluntary redundancy formal offer in March.
Okay.
This will specify, so this correspondence will specify my date of leaving as the 31st of May, as I will be required to work my notice period.
Okay.
So I expect that date of leaving, as specified in my voluntary redundancy offer letter, to be reflected in my LG16 form, the advance notification of an intended retirement. So my question is, you use the term point of redundancy. I take this to be the date of leaving expressed in my LGS form. Is that correct?
Yes.
Thank you.
Okay. Any other questions? I've seen there's a lot in the chat.
Ruth, Rebecca from Belfast Met.
Hi,
Sorry,
Rebecca.
I had popped it in the chat for Leah earlier. It's just a question of if you're over 55 and you're leaving, do you have to make the decision on taking the tax-free lump sum at that point, or can you take it at any point? As in, I'm assuming you can only take it, say, like once a year, or do you have to notify at the time of leaving to say, yes, I want this amount of tax-free cash?
It's at the point that the pension comes into payment. Okay. You only get one opportunity to do it. It's either take it when you retire or you take it all as pension. You don't get an opportunity further on down the line. No.
Okay, great to know. Thank you so much.
All right. Moira, do you want to unmute yourself and ask me a question?
Yes. If we have a redundancy payment, for example, of £40,000,
yes,
and we only are paying, we don't, the first 30,000 are you don't pay tax on them.
Yeah.
The additional money, say the £10,000, do we have to? Can we put that into our pension? And can we put it into our pension as a means of not paying tax on it? Or what? I mean, what would you recommend?
Can I clarify, is this your statutory redundancy payment, or is this an element of an enhanced redundancy payment?
This is the enhanced one that we're being offered at the moment.
Okay.
And yeah,
you do have some options. When it comes to your statutory redundancy payment, you can't put any of that into your pension. That is a payment from your employer that is not part of pensionable pay, and it must be paid to you. However, if your employer is awarding you an enhanced element of redundancy pay, you can elect to instead receive that money as pay from your employer and pay tax on it. You can instead request that they use that enhanced element to increase your annual pension from NILGOSC. Once that buys you extra pension in NILGOSC, you have the option to do the 1-to-12 conversion option and take it as tax-free cash. But it's only if there's an enhanced element to your redundancy pay, and it can't be any part of your statutory redundancy payment.
Well, this would be part, because we're being offered an enhanced payment. Say, is that something that you would recommend? That because we will have the say 30,000, and then you have an additional 10, 20,000 or whatever. Would you recommend putting that into your pension, especially if someone has only been paying into their pension from maybe their late 30s?
I have to caveat my response before I answer.
Oh, no, that's fine.
NILGOSC staff aren't qualified or regulated to give financial advice, so I can't tell you what's best or if it's a good thing. But I can tell you, I can tell you that if you put your money into the NILGOSC pension, you'll be able to find out how much extra pension that would buy you, and that is a guaranteed figure that will never be devalued over time. So once that's in payment, you know, it is protected. but it's entirely up to your own circumstances. I mean, it could be that you do want to look at more income coming from your pension, but some people just prefer the extra cash up front, albeit that they're paying tax on it, because maybe they have a mortgage to clear, or they want to get rid of any outgoings that they may have in retirement. So there's no one is better than the other. You just have to weigh it up for your own circumstances and work out what's best for you.
And take financial advice, not from NILGOSC.
MoneyHelper, they have pension wise, I think it's an hour, is it 45 minutes or an hour long session they can give you. Now, they can't talk figures with you, but if you talk to them about your options, they'll be able to give you guidance, and they are impartial. So do check them out and they'll be able to help.
The other thing is, if jumping in here, if you're a member of NIPSA, you actually can get financial advice for nothing.
That's correct.
And that's what I would be recommending to people. It's with Platinum Finance.
That's correct.
If anyone wants to contact me about it.
That's correct.
Sorry about this. Yeah.
For any people that are a member of the NIPSA union, I myself have been to some of Platinum seminars, and they're great. They know the scheme inside out, so they are great.
Listen, thank you very much.
Thank you. Okay, next I'm going to ask Kevin Lynch. Would you like to unmute yourself and ask me a question?
Yes, I would indeed, Ruth. First and foremost, thanks very much, by the way, for the presentation. It was great, very informative and very clear. What I suppose my question is, I think I've been playing with your online portal quite a bit recently, as we all have probably, and putting various options in. But in one of the options, just for voluntary pension, there's a slider option which allows you to see when you convert some of your pension into a lump sum up to a maximum that's tax-free. That option isn't available in redundancy, though you have went through this in slide 13 very clearly. Will that option be available? Because it's very handy, I think, for anybody to see at a quick glance what those options might be.
Yeah, we asked our software provider, and it's on their to-do list, but we're talking years down the line. It's not going to be of any benefit to anybody now, unfortunately. So if you are looking at your conversion options, it's either going to be a manual calc as per slide 13, or wait until you get your claim forms from NILGOSC, and we'll confirm what that is. Sorry about that. It's just a limitation of the software.
No, you're okay. This is probably a stupid question then. You have a divider of 56 there. What's the reference or relevance to that?
No idea. Somebody smarter than me told me use that and it'll work. I honestly don't know what it is, honestly. Right, okay. But yes, it does work. It does work. You'll get sort of within pence of the actual answer. So yes, 56 does work, but I don't know the significance. Sorry.
That's great. Listen, thank you very much again.
All right. Thank you. Jane Stevens, I think you're next. Do you want to unmute yourself and ask me a question?
Hi, Ruth. Thank you. I have two different. I didn't join. I left one college and joined another, so I didn't join the two pensions together. Do I use the deferred members one to get the old one then, and just add the two together?
You'll have two separate pension pots from us. Only one. Sorry, can I ask, are you over 55?
Yes. Well, I am 55. No.
Okay. So. Well, only one of those pensions will be payable in the event of redundancy. You'll have to go into your deferred pension account and do a voluntary retirement calculation, which will have reductions.
Okay. So how does that work then? Because if I take the redundancy.
If you take the redundancy, it's only your current active pension pot that you're paying into that will become payable. So make sure when you're in the online calculator that you're in the correct one. Right. Because you'll be able to select between them both. One will say active and one will say deferred. So in the active one, that's where you're doing the redundancy calculator. Yeah. And in the deferred one, that's where you'll be looking at either taking voluntary redundant or voluntary retirement, in which case there will be reductions, or you can leave that sitting till later and then bring it into payment at another date. Okay.
Perfect. Thank you.
Thanks. Next, Francis Fulton, would you like to ask me a question? If you'd like to unmute yourself, there should be an icon that says mic with a wee line through it. That's you. There we go.
Just got it. It's more to follow on from what Maura was saying. The putting in the money from the thing. Just when do you do that?
It happens before your redundancy payment is made. So if you're thinking of going down that route, make sure you speak to your employer beforehand, because they'll then be able to contact us to find out how much extra pension that enhanced element of redundancy can purchase.
Right. Okay.
Okay.
That's it. That's all I.
Okay.
So I just don't want to miss the boat.
Miss it. Yes. No, you're just right. Get in there early. Okay.
Yeah.
Donna Flynn, would you like to ask me a question?
If you're in the 180th scheme, see if you're in the 180th, the 160th and that 149, does that all calculate and does it come into your final figure?
Yes, if it's all in the one account. So if you have been in the scheme through the 80ths and the 60ths and the career average, then yes, it will all kick in. And if it's all under the one pension record, it will all be unreduced in the event of redundancy. But if you have separate NILGOSC pension pots, maybe from a different employer or a separate employment, it'll be only the current active one that you've been paying into. Do you just have the one NILGOSC pension with us?
Yeah, it's just the one. And then I did transfer when I started employment. I transferred some money over from my previous. I had a previous private pension.
That will be included.
That's included.
Yeah, that will all be included. Yep.
Okay, lovely. Thank you.
All right, thanks. Next, Kimberly McKnight, would you like to unmute yourself and ask me a question?
I think that's totally separate, but I just like everyone have been looking at options, and one of them that had come up for me was flexible retirement, possibly. But that's a completely separate thing, nothing to do with well, I've been told it's a mitigating option for redundancy, but I don't think it has any impact. It's a totally sort of separate issue to talk to NILGOSC with. Would that be right?
If you don't take the redundancy payment, if you instead reduce your hours and they agree to flexible retirement, you can release the pension that you have built up, but it will be reduced. Whereas if you accept the redundancy, it's unreduced.
Okay, that's very helpful. Thank you.
All right, thank you. Stephen Kennedy.
Thanks, Ruth. It was just in relation to what you mentioned about the possibility of buying additional NILGOSC pension with the enhanced redundancy payment. Does the enhanced redundancy payment always include an element of statutory redundancy?
No. The only thing that your employer is obliged to pay you under law is the statutory redundancy payment. And the first 30,000 of that is tax-free, but any element over and above that, you will pay tax. I'm not aware of individual redundancy packages, but I do know that if an employer does offer an enhanced redundancy payment, it's only the excess above the statutory amount that you can use to buy additional pension, and you either use it all or none. You can't use some of it.
So if you were paid £30,000 as an enhanced redundancy, could all of that 30,000 be used to buy additional pension?
As long as none of that 30,000 is the statutory redundancy payment.
That's
yes.
what I mean. So how would I know if any element of the enhanced redundancy has an element of statutory?
You'd have to ask your employer. We don't have access to those figures.
No problem. Thank you.
Anna Flynn, do you have a question for me?
Sorry, I had asked previously there. I'm okay.
Sorry. All right, okay, no problem. So if anybody does want to ask me any questions, now is the time. But as I say, I'll keep the chat open for another couple of days. So if anybody wants to ask me anything in there, I'll do my best to get a response out to that. As I say, NILGOSC will be in touch once we get notification from your employer. Once we get the claim forms out to you, there's still just a quotation at that point, so they won't be final figures. We won't know your final figures until you've actually left and they've made their last payment to you. But hopefully you'll have enough information with your online calculator that you'll be able to make your decision. But if you do need any more information, please do come back to us. There is a slide in here to let you know how to contact us. It is slide number 20, the last one in your slides. But apart from that, thank you very much for your time this morning.